Chapter 10, Part 4, Research and Development under GAAP and the International Standard, and we're going to look at software development. So you should understand that when we make a new product, they actually have two phases. There is what we call the research phase, which is planned search or critical investigation to discover new knowledge. And then we have the development stage, a translation of research findings into a plan or design. So, under GAAP, both research and development costs are expensed when incurred. Legal and filing fees are capitalized as an intangible asset. But under the international standard, we are allowed to capitalize development costs. So, treatment of assets purchased for R&D. If an asset is purchased for a single R&D project, we have to expense it. But if it has multiple uses, then we can capitalize it and depreciate it over the service life as part of R&D expense. Now, research and development activities, we again have to expense both. We don't separate them out, but under the international standard, they do. But both GAAP and the international standard say that direct costs to secure a patent, such as legal and filing fees, can be capitalized. So let's take a look at an example. So here we have Mike's company. They have salaries. We have three items that are basic research. Then we have development costs. We have legal fees. And we have equipment that has multiple uses in a 4-year life. So we are going to expense our salaries, material, and other, because those are our total research costs. And we're going to expense our development costs, and then we're going to depreciate our equipment over the 4 years. So in this case, we'd have research and development expenses for the year of $6.825 million. We'd have an intangible asset of $50,000 and equipment of $100,000. Now, under the international standard, it would be different. They would only expense $5 million, and they would capitalize the development costs. What about software development? Costs incurred up to technological feasibility are expensed. Technology's feasibility to the release to the public can be capitalized. And it will be amortized one of two methods, whichever gives you the highest amount, percentage of revenue or single straight line. So let's take a look at an example. All right, on September 20th, we began developing a product, and we achieved technological feasibility February 28th. And the program was available for release on April 30th. So what are we going to do with these costs also? We have expected useful life of 4 years. We expect to make $6 million on revenue. And during 2025, we actually did make $2.4 million in revenue. Now, what are going to be our journal entries? Well, in our first year, we're going to expense the $2,370,000. In 2025, we're going to expense the $970,000 because that was before technological feasibility. And then we're going to capitalize the $570,000, which is after we incurred after we reached technological feasibility. Now we're going to look at how do we amortize. Well, we can even do it as a percentage of revenue, which gives you $228, or we can straight line it. And we use whichever is higher, and therefore we would use our 228 and use percentage of revenue, and this would be our entry. Now remember, whenever you amortize, there is no accumulated amortization. It goes directly against the asset on the balance sheet. Now the last thing we talk about is startup costs. Just remember, all costs associated with organizing a company are always expensed. And that completes this part of our presentation.